Now what we can do is look at an example of market structure here on a price chart, and we're going to use Euro-US dollar as an example to convey the overall mapping of market structure and just the general idea of it. One thing we'll be doing in future episodes of the market structure series is how to properly map out market structure. But for this example, what we're going to be doing is just more or less focusing on price creating higher highs, creating higher lows, creating lower highs, and some of the supply and demand applications that we might be able to see. One thing I wanted to add before we get into this too much is that although in the previous video we discussed supply and demand and the application to it, having demand being respected and supply failing for uptrends and supply being respected and demand failing for downtrends, one thing that should also be stressed and mentioned is that the supply and demand zones may not necessarily appear or be as present on one particular time frame, and this is where the fractal nature of the markets really do come into play. So what you may see is an uptrend on a daily perspective. You may have a daily demand zone, but once you go down to a lower time frame, there might be a supplier demand zone that is less visible on a higher time frame that might get a reaction that then creates that higher high or lower low depending on the market profile. But what we can see here on Euro-US dollar is that initially price is creating an uptrend. We're creating higher highs and higher lows. And what we can see just before we touch into much is we had a high here. We've broken this high, creating a higher high. Our low would be right here. We created a lower low. So we're kind of in a stage of breaking highs and breaking lows. But what we can see is price creates a high. So what we would then be doing is looking at price in a trading range of this particular low and this particular high. It is an incredibly large trading range and not something that I'm a huge fan of. And this is just unfortunately the way it would map out using the lowest low to the highest high of that range. Of course, if you were to run into an event like this, you might want to reduce the trading range, but at the same time, what you could do is just monitor the substructure that is within this point. If we do break below this point, looking at substructure, looking at supply and demand, and using that as a basis to develop whether or not things are changing. But for the most part, what we can see is we have a large trading range and price doesn't even come down to this lower half. So it's less of an issue. What we can see is we create this high, price creates a complex pullback where we're creating substructure before we actually end up moving to the upside. And we'll just zoom in a bit to get into more of this price action. But what we can see when we zoom in is we have this high, and basically what we're looking for is price to either, just zoom out one more time, we're either looking for price to break this high, creating a higher high, which would then confirm that the bullish market structure is still present and that we're still in an uptrend, or breaking a low to point, or printing a lower low by breaking this previous low, which would then signify a lower low. But as we can see, price does end up breaking this high, creating a higher high. And what we can see as price begins to correct once we put in this high is a complex pullback where initially we might think that this is the higher low. We might think that this is the higher low. We have this as a higher low, and then price finally moves to the upside, breaks to the upside, creating a higher high right here. And then what we can see is price creates more series of higher highs, higher lows, higher highs, higher lows, followed by a higher high. And then what we can see is the trend actually switches where we get this impulsive move to the downside, creating a lower low because we've broken the previous higher low. We then create a new lower low. This would be our lower high. And we would be mapping out our range just like this. And what we can see is, although we did wick break the previous lower high, we never actually closed above the high. So for this example and for how I map out market structure, which we will talk about in a future video, I would consider this still part of the overall downtrend, especially because what happens next, we see a large move to the downside that breaks structure, creating another lower low. We then pull back, create that correction, and then break to the downside, creating another lower low, which would create our lower high right here. And then what we can see is then price moves to the upside, breaking the previous lower high. We retrace, we create a higher low. The higher low is confirmed once we break the previous high, creating a new higher high. We pull back, creating a higher low. The higher low is confirmed once we break the previous higher high. We create this higher high, and then what ends up happening is price breaks to the downside, creating a lower low. And at this point in time, we're just trading within this overall price range, waiting to see if price does in fact break this low, creating a new lower low, or if it moves back to the upside. But as we can see right now, we are in a bear trend. We have created a lower low and potentially are about to create a new lower low. Now, when we add in some supply and demand applications to this overall move, what we can see is we have a demand zone, which if we look at episode 4, we can see that within inside this wick, there's a demand zone that would be present. We also have a demand zone right here within this wick as well, which we could use this entire candle, but it's been refined to the wick itself. And then we finally have another demand zone right here in this pivot demand. We also have another demand zone that's in here, or more specifically this wick, as well as demand zone within this wick. Lots of demand zones. But what we can see, and something that I've mentioned several times, is that supply and demand zones will get a reaction almost every single time, but it's the follow through that we're mostly concerned with. So as we can see, we have this demand zone that would be on a lower time frame within this wick. You can see that we do get a reaction, but then that causes the demand zone to fail. We did create a supply zone here as well, which is ultimately what caused this break of structure. We can see that supply was respected. Price moves to the downside. We have another demand zone to tap into. We can see that initially we respect that demand zone and start moving to the upside. And because our market structure is between this range, this is where we're anticipating price to either respect the supply zone within here, within this bit of price action, to create a lower low, or if demand is going to pick up, we're expecting a higher high. Initially, before this candle closed, we may have thought that we created a higher high, but what we ended up doing is tapping into this supply zone and moving to the downside quite rapidly, creating another lower low. The lower low is then tapped into this demand zone. We could even refine to this inside bar as well, or just these two candles in specific. And what we can say is we do get a reaction. The reaction doesn't necessarily hold. Again, in video 4, we have these wicks right here, which would be a continuation supply zone. We do move just above that supply zone, but ultimately it does hold until we tap into this lower demand zone that is resting within this wick. We get that reaction, and then price moves to the upside. And again, something that I mentioned in the reversal and continuation models supply and demand zone video, that more often than not, the reversal models tend to hold more than the continuation models. And what we can see, just adding on to that, is that we have a continuation model, 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 all of which do get a reaction but don't hold specifically, whereas we have a reversal model, and as we can see, price taps in, moves away quite aggressively. We have a reversal model, price taps in and respects it quite heavily. So again, this is just something to add on and build onto the supply and demand section. As you can see, we're building from each concept to add onto each of the pieces so that we can better understand the markets. We can better understand what's happening behind price action. Supply and demand is definitely the first and most important component of our strategy. But then once we combine it with market structure, we can then begin to understand what's happening behind the scenes and what trades we should or maybe shouldn't be looking at. And then finally, if we just continue on, what we can see is we have a demand zone right here, which we have not actually mapped out, nor have we tapped into as of yet. We have a demand zone right here, and what we can see is price respected it initially, and what we can see is price broke below and then immediately retraced in. So initially we did see some minor respect of the zone, but ultimately this zone has been disregarded entirely. Again, this is where we would see a continuation model. We can see that we have, if I just draw this one on as well, we have a demand zone that was respected, and we can just continue on. But what we're seeing is we're seeing bullish structure. We're seeing demand zones holding, and what we're seeing is supply zones failing. What we have right here is we have a supply zone. It fails. Create a demand zone. We continue to create higher highs and higher lows. We have a supply zone, more specifically within this wick. That supply zone fails. We have a supply zone within this wick. That supply zone fails. We have a demand zone. The demand zone is respected, and price continues making higher highs until we tap into this supply zone that is more at the origin or the extreme of the move, and it's also a reversal model, and that's where we can see that price has now turned and is moving to the downside. But But this is just a quick example of market structure here on Euro US dollar with some integration of supply and demand zones and the relationship that they have between each other. Because as we can see, it is quite powerful when you understand supply and demand, where you can see where price is likely to see a reaction. We combine it with market structure, we can see the likelihood of that reaction following through or failing to follow through. In this case, what we can see is price was in an uptrend, but then we switched to a downtrend. We started reacting to demand zones, but the demand zones failed to actually hold price and follow through with a higher high. And we've seen price continue to move to the downside. So from a trading perspective, what we can use this sort of identification as is a good way to manage our take profits or to lock in profits when we know price is going to tap into these zones, cause some sort of reaction that may or may not cause a reversal of price or a follow through of price. And just to add one more further part, just to look and dig into this bit of structure, what we can see is we have a supply zone right here. You can see that price respects the supply zone. We're creating substructure in this complex pullback. Supply zone, we can see the price returns back to the supply zone, comes back down. And then what we see within this bit is we have a demand zone. Demand is respected. We break supply, but ultimately we've respected supply. We've broken demand, but we're still well within the range of price. And then we can see price move to the upside and then eventually break demand. But what this supply zone creation right here was doing was making it so that once price moved to the upside, it had very minimal resistance or selling orders to get in its way as it pushed up. And as we can see, once we started to clear above these supply zones, price had almost no issues moving to the upside. So again, just a quick example on Euro US dollar. In the next video, we'll go through multi-time frame structure and how the relationship between, say, the daily, the 4-hour, and the 15-minute, and how the mapping of each time frame's market structure goes hand in hand.